Joining us this morning, Truist Wealth Chief Investment Officer Keith Lerner is with us. Keith, it's good to have you. And once again, we're back in a conversation about how much of this is real risk to the economy and our standing in the world, and how much is going to apply to earnings of the S&P.
Yeah, well, great to be with you, Carl, and the crew. And I think you laid that out absolutely the right way. And, at this point, we've had over the last year what I call a carousel of concerns. We have one concern that comes up. As that fades, another one comes up. And it's just kind of the environment that we have to live with. But I would say, from a market perspective, staying away from the political side, Fed independence is important. And the way that, I think investors should track this is how this manifests itself. And what we're looking at closely is the movement in the 10-year Treasury. I think that's one of the biggest risks to the market this year, even though we're positive. So far, the reaction, as you see, Carl, relatively muted. We are seeing the other side of this, too, where the currency, the U.S. dollar, is coming down a little bit. And you are seeing today international markets outperform. And you're seeing gold up over 2%. We've been favorable on gold all last year and remain so this year as well. So, Carl, put this all together. This just tells me more broadly as you're investing, you have to be more diversified and more globally diversified than maybe where you would have been a year or two ago.
So would you anticipate more calls to take international from an underweight to an equal weight, or even more aggressively ex-U.S.?
Yeah, I think in general, you'll see maybe more of a pivot towards that way. I'll be careful not to try to overreact to any one, headline. And, in the U.S., though, even though it's been underperforming somewhat recently, the technology sector still has a lot of earnings momentum. Excuse me. And over the weekend, we saw this big announcement with Walmart and AI, and Walmart's up today. So, excuse me, on the margin, I would say you'll probably see more of a pivot. We still have a modest bias to the U.S., but it's less than where it was, say, the last few years.
I mean, if we're talking about things, just reflecting on this conversation I just had with Janet Yellen, if we're talking about things like Banana Republic and Fed independence seriously compromised and a Federal Reserve that will be forced more to do the bidding of a politician, why is the dollar only down 0.3%?
Well, I think because we've had a lot of headlines over the last year, and I think if we go back to last April, the market, in some ways, overreacted to some of the headlines, and some of the things actually didn't come to fruition. Meaning, where terrorists were last year, what the expectation was, and where it ended was a lot different. So I think the market's still trying to sort out what is, actually market impact versus potential noise. It's too early to say with clarity. So I think the market is taking more of a tepid initial reaction, and to see how this plays out. Again, I think having that recency bias of the last year is having investors where they're not reacting as sharply as if this announcement came out at the same time last year when we had, a new, fresh administration. We're adapting to these kind of onslaught of headlines that keep coming.